Hi, Michael Yardney here, and today's episode is something a little different, but a special one, and I'm thrilled to be sharing it with you. You see, I recently had the privilege of joining Felicity and Candice from the Talk Money to Me podcast. And let me tell you, it was a fantastic conversation, so today I'm going to replay that interview. Now, whether you're a budding investor, just dipping your toes into the water, or a seasoned pro with a robust portfolio, I'm sure there's going to be something in this chat for you. You see, I've been involved in property investing for well over 5 decades, and during that time I've seen it all. I've seen the highs, I've seen the lows, and all the bits in between. And through these experiences, I've fine-tuned frameworks that have not just weathered the storms, but thrived amidst them. So in our chat today, I dive deep into the current state of the property market, and given the challenges many property investors are currently facing, hopefully by answering Candice and Felicity's questions, I'll also be answering some of your questions. So for those of you who are new to the scene, consider this an episode that's going to give you a roadmap. And for experienced listeners, while some of this may feel like a refresher, you've heard me say these things before, I really hope there are some nuanced distinctions that even you might have missed along the way. And all in all, it's really about future-proofing your investments and ensuring you're not just surviving, but thriving in the markets that are ahead, because we're at the beginning of a new property cycle with some great opportunities for those who know what to look for. So without further ado, let's dive into my chat with Felicity and Candice from the Talk Money to Me podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome, Michael, to Talk Money to Me. We're so excited to have you on the show today.
My pleasure. Thanks for having me.
Now, we'll jump straight into it. Can you provide an overview of the current state of the Australian property market and how has it evolved in recent years? And I guess an additional question here, where are we in the property cycle?
Okay, well, I love that question because there isn't one Australian property market. Let's be clear. There's multiple markets. Each state's in a different stage of its own cycle, and within each state there are multiple markets, depending upon price brackets, the type of property, geography. Now, having said that, I understand what you're really asking. And if we look back over the last year, Australia's housing markets have continued to defy expectations, despite 12 interest rate increases from the Reserve Bank, which has seen official rates rise by 4% over the last year. Property prices have not only stopped falling at the beginning of this year, but they've actually been on the rise for 8-9 months now. Now, last year in 2022, we experienced a property downturn where the peak to trough change in the market was about 9% according to CoreLogic. But it's now confusing analysts. If you look back this time last year, even the Reserve Bank thought we'd have double-digit fall in prices, and a lot of other analysts said prices were going to drop 15, 20, some even 30% on the back of interest rate increases. But it's now clear, Felicity, that the market's bottomed at the beginning of this year, and we've moved into the new phase of the cycle, the recovery phase of the property cycle. And I guess that's been helped by low listing volumes. There aren't many properties for sale at a time when, in fact, we've had huge population growth. And while others were concerned about the fixed rates cliff, mortgage rates changing from fixed rate to variable, we can talk a bit about that later, none of that has actually affected property prices. And with inflation now likely to have peaked and interest rates probably near their peak, maybe one more rate rise, I think in due course consumer confidence is going to return even stronger and the markets are going to continue their upward trajectory. That's a long-winded version of where we were and where we are today.
No, that's a great response. And I guess it's what, property investors want to hear at this stage as well.
Well, again, we're in a rental crisis as well, and maybe we'll have a chance to talk about that, because not only is there a shortage of properties for sale at a time that our population's booming, but in fact there's a shortage of properties for rent, which means that vacancy rates are low and rents are skyrocketing.
Yeah, that's a really good point you've brought up there. Let's go there if we can, just really quickly on the rental property market. What are you seeing as a catalyst for something to drastically change here?
Nothing. Sorry about that, Candice, but the answer is there's been a lot of government talk, hasn't there? And there's state governments getting involved as well, and the federal government has come up with an idea about how to build it was initially 1 million, now 1.2 million properties in the next 5 years. A lot of talk, but nothing much happening. Interestingly, it's really just related to supply and demand. At the moment, there's very, very strong population growth. A large part of it is students, full-time immigrants, but also students have taken up all those apartments. Remember, for a couple of years, we didn't have students coming into the country, so net immigration, because there's always people leaving, people coming, but there weren't all the students leaving at the end of their tertiary experience, and so therefore there's been a big demand. The other thing that's changed, Candice, is how we want to live and where we want to live. So there's actually fewer people per household. There's actually a little bit decrease in the number of people per average household. There's more single and two people households. And that, according to the census, has created the requirement for just 120,000 more dwellings just to house the current population. Plus, many of us are looking for a Zoom room. You're working from home. I'm working from home at the moment. We've got a hybrid relationship with work for a lot of people. So it's even meant that we need more rooms, more accommodation. All this has put pressure on the rental markets. And what's going to happen is we need more supply. There's been lots of ideas about how that could happen. But the next round of supply of particularly apartments, but also houses, is going to cost a lot more. So that's just going to mean that developers aren't going to start building until markets go up even higher to make it financially viable. So I think we've got a rental crisis on our hands for quite some time.
Yeah, that is concerning to hear, I guess, and that's the reality. And as you said, it is a bit politics and it's all just headlines and a lot of stats and data, but nothing's really, I guess, addressing the issue. So if we take a step back, whether you're looking to join the rental market or buy a home or another investment property to add to the portfolio, what are the key factors or strategies that you advise, Michael, or consider for Aussies out there?
If you're talking about property investment, it's a process. It's not an event. You actually need 20, maybe 30 years of investing to develop a level of financial independence. So I guess the first question to ask is, what's your plan? What's your end goal? What are you trying to achieve? Because you need a strategy. Look, there's more than one way to get to your end goal. Some of our clients who at Metropole who want to get involved in property investment want to take it more slowly. They want to go overseas for a while, or one may stop their job and have a baby. So one has to actually have a plan that will suit your lifestyle. The plan doesn't just involve the end game, but you've got to have an end game to get to. And it's got to be more than I just want to get to Sydney. You need to have a street and an address in Sydney. In other words, you want to know what lifestyle you want in the future, what choices you want, because people invest to give them choices down the track. And then part of the strategy, the plan, in my mind, has to be a finance plan, an ownership plan, a tax and structuring plan, a plan to maximise your growth, but also to minimise your risk. And whether it's a home or an investment, I think it's important to recognise that location, where the property is located, that does 80% of the heavy lifting. I guess any property could become an investment. You kick out the landlord, you put a tenant in, it's suddenly an investment. But that doesn't necessarily mean it's investment grade, Candice.
Yeah, exactly. And one quick follow-up here, if I can. Do you believe in the idea of renting in the area, like you said, to find the postcode, the lifestyle, tick, 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 before you potentially make such a bigger purchase as a home or an investment?
Well, there's a concept called rent vesting where a lot of people want to live in a particular area but can't afford to. And so I'd be suggesting that it's for a lot of young people, it's a great idea to rent where you want to live, where your lifestyle is, where your friends, your family are. But if you can't afford to own it, rent there, but then buy somewhere where you can afford. And some people say, oh, look, rent money's dead money, but not if you've got on the other side of the equation a tenant paying you rent for the investment property that you own.
Yeah, absolutely. And I mean, Michael, you've had so many great articles out. And I remember reading an article that spoke about, the best regions and cities in Australia that are showing the most promise for growth potential for property investment. Can we go into that a little bit more detail and why you've kind of selected those regions and cities?
Well, I'm sometimes pushed by the media. Tell me the best 10 places in Sydney to invest by the end of this year. I hate those sort of questions because, as we've already said, property investment's a long-term affair. So you need to understand where a property or a type of property is going to be in continuous strong demand in the long term. Now, in the long term, our Australian fundamentals are going to be good. I believe in the future our Australian economy is going to keep growing. We're going to be a wealthy nation, and the government's got a business plan of increasing our population to 40 million people by the middle of this century. So if there's more of us and we're going to be wealthy, that's going to keep pushing up property values, but our markets are going to be fragmented. The gap between the more affluent areas and the cheaper areas, in my mind, is only going to get bigger, as happens in all big cities. Our capital cities, and in particular the three big capital cities, Sydney, Melbourne and Brisbane, are likely to outperform because that's where the bulk of the population growth is going to be over the next decades. And in general, houses will outperform. They grow faster, they grow better, and therefore the rents go up than apartments or townhouses, but not everyone can afford a house. I'd rather own a family-friendly apartment in a beachfront suburb of Sydney overlooking Bondi Beach or those areas than a house 50 kilometres out from the CBD. I think the other style of accommodation that's going to become more preferred by many people as we move into a more densified lifestyle is going to be townhouses where you've got large modern accommodation on compact blocks. So the intergenerational report, which recently came out, and the government's talk about how it's going to build these 1.2 million properties, all shows that we're going to live in much, much denser cities moving forward. So I think one of the things we're going to have to get used to is living in medium density and in some cases high density accommodation, but I'd be sticking to the more affluent and in particular the gentrifying areas of our capital cities. And I've got a strategy, I've got a plan of how to find those, and maybe we can chat about that down the track.
Yeah, absolutely. That sounds great, because you also wrote an article based on why neighbourhood is so important.
Hey, I'm really impressed that you're reading my things. Thank you.
You spoke about how neighbourhood's so important. And what I actually really liked is you did actually mention my neighbourhood where I live in Rozelle, Balmain, because obviously we're close to the city, but the houses haven't quite boomed. I mean, you still can get a house for around the $2 million mark.
They haven't quite boomed. You tell that to people in regional Australia.
Well, that's true. But boomed from a Sydney CBD compared to the eastern suburbs, for example.
Yep.
You can't buy an apartment there for $2 million, but you can buy a house in my area for $2 million.
Well, neighbourhood is important. I think that was brought home during COVID, but it stuck. The concept of a 20-minute neighbourhood is a town planning concept where it's a nice idea to be 20 minutes from work, if possible, but also amenities, and not just one supermarket, but a Coles and Aldi and a Woolworths, to have near gyms, near places of worship, near parks, near recreation areas. In Melbourne in particular, where I am, where we were locked down for 260-something days, it became very important, but it always has been. It's just been accentuated. And so therefore, if money was no object, more and more people would want to live in the sort of areas that you talked about at the moment, the inner suburbs of Sydney, Melbourne, Brisbane, and in fact all our capital cities. And you can't tell me that properties 40 kilometres out are going to become as expensive as properties 3-4 kilometres from the CBD in 20-30 years. The gap will always be there. The rich don't like to commute. It is a challenge. It is a social problem. But basically, those more affluent established money areas are going to outperform in the long term because of the amenity, because they're gentrifying. So it's not just the wealthy people are there, but it's also wealthy people with more incomes are moving into the areas and doing up those older places.
Yeah, that's really good insight. So we have, Michael, just for some context, quite a few listeners in the brackets of, 18 years to 35 years. So if we generalize and say they're your typical first home buyers, what would you say to potentially a listener who's thinking about getting into the property market for the first time? What would you say, some strategies for them to consider to help maximize their chance of success or minimize risks?
Well, let's talk about the concept of property investing that a lot of people want to in that age group. And we talked before about maybe renting where you want to live and then investing somewhere else. First of all, understand the odds are stacked against you. 50% of investors who sell up in the first 5 years. In fact, the most recent CoreLogic Pain and Gain report showed a lot of selling up after 3 years, and 92% never get past their second property. In fact, ATO stats show that only 20,000 investors in Australia, around 20,000, own 6 or more properties. That's 1% of investors. Now, interestingly, a recent audit of the results of our clients at Metropole showed they're 7.3 times more likely to fall into that 1% of property investors. But by the way, this doesn't mean you shouldn't get involved in property investment. It means you've got to do things differently to the average investor. You've got to listen to different people than the average investor. Look, be careful who you listen to. There's 25 million property experts in Australia. Every weekend, people give you opinions. Just because they've got an opinion doesn't mean you should be taking their advice. I think the other concept is that residential real estate is generally a high growth, relatively low yield investment. But there's lots of gurus out there telling you, or so-called gurus, if people could see us, I'm using sort of finger quotes, that recommend investing for cash flow. I think it's also important to realise there's stages of a property investment journey. Educate yourself first.
Yeah.
Because it's a big commitment. Asset growth is the next stage. Your job is to grow your assets, and that can take 15, 20 years and a couple of property cycles at least, and then you slowly lower your loan-to-value ratios and live off your properties. But I think a real message I'd give everybody who's starting out is don't do it on your own, whether it's for your own home or for an investment. Get a good team around you, a financial planner, a mortgage broker, get a smart investment savvy mortgage broker, a property strategist. And maybe there's one other thing I'd like to share, and that's don't be too scared about it. It is a big decision, but only listen to people who know what they're talking about. Because as I said, everyone's got an opinion, and the media loves sensational headlines. You turn on the news and you hear about property, but mainly the bad news. Remember all the talk last year, only 12 months ago, about a recession, about mortgage cliffs, about property values dropping. It doesn't mean this information is useful. Most property journalists don't have any economic background, so be careful who you listen to. Now, the last thing, you don't need to know everything before you get started. It sounds really, really complicated. If you want to know everything, you're just going to get to the stage of procrastination, analysis, paralysis. But get a good team around you, and you're going to make mistakes. And I mentioned a while ago to have a plan for your plan not to go to plan, because things go wrong along the way.
Yeah, and you know what? I think you mentioned this earlier, and it's a very key point. I've had a lot of people say to me they're just waiting for the property market to drop, waiting, and they've been waiting all year, right? And they're continuously waiting. So that's that procrastination that you spoke about, waiting for a better deal. And sometimes, it's probably, like we've seen in the last year, property prices have actually gone up in those key areas. They've not gone down.
Could I just ask, who'd like to buy their property their parents bought at the price their parents paid 10, 15 years ago, but you speak to them and it was scary, it was nerve-wracking, it seemed expensive at the time, it just didn't make sense then either. It never seems all right.
100%.
Correct. And you know what? So I've bought 2 properties, and when I've actually purchased them, I've stretched myself a little bit, and they've worked out very well over the long term. One's been held for 10 years and one's for 3-4 years now. So I think it's about holding on to the assets in real term as well, in long term. And I guess true. On this, coming back to key indicators. So you did mention it before, growth and yield. I mean, what are some key indicators or metrics that investors should track to assess the health of the property market in their chosen area?
Well, I think one of the things that's going to drive the property market in a particular area is the demographics. It's something most people don't think about, but I like to look at the demographics of an area. Are there more owner-occupiers than investors? So those areas where it was dominated by investors, like the inner CBD apartment market, for example, they're the areas that suffered during the recent downturn, and other ones as well. But if you've got areas where there's a large number of owner-occupiers, particularly ones who've been around for a long time, many of them have paid off their mortgage. If you look at the statistics, 50% of all homeowners in Australia, 50% of homeowners don't even have a mortgage. So I like investing in areas where there are affluent people. The demographics suggests that they've got incomes going up above average. And as we mentioned not just those people living in the area, but those moving into the area, gentrifying suburbs. That's a good indicator. Now, what a lot of people look at, well, I think there's two things. They look at auction clearance results every Sunday, Monday, but also median prices. That's, in my mind, one of the worst indicators. And we've got a buyer's agency in Melbourne, Sydney and Brisbane and help home buyers and investors purchase properties. And people keep coming to us with, this is the median price of the area. It's a very poor indicator, even though it's one of the most commonly cited ones. They're not as meaningful in some areas as others. So I live in the suburb of Brighton in Melbourne. I'm in a lovely apartment, in a penthouse apartment, a couple of doors from the beach. There's a particular street, St Kilda Street. So all those houses close to the beach have got the same postcode as the other houses on the other side of St Kilda Street that don't have walking distance to the beach or access to the beach. And so therefore there's a different type of accommodation, different type of house. Then you go further into the same postcode, Brighton, and there's a whole lot of older, quite historic properties. So median prices are meaningless in my area because within that area there are multiple different sorts of property. They're more meaningful in areas where there's a more homogenous market.
Like a subdivision.
Yeah, so new estates. Having said that, if there's all of a sudden been a new block of 1-bedroom or 2-bedroom apartments, that may lower the median price in an area. But that's, again, one of the things that's frequently cited. But when you asked how do you choose the health of the area there, in fact, I'd be looking at demographics rather than the reported median prices, Felicity.
That's a really good insight. I'm really loving that. That makes a lot of sense, particularly when you've explained your own personal circumstances with the different pockets within your one suburb. So if we stay within that mindset, I'm reading a lot of reports about the opportunities in Perth and Brisbane, in the growth corridors there. Are you seeing that? I guess what emerging trends and pockets within the Aussie market is looking attractive from your perspective?
Okay. Growth corridors often mean more people are moving in. More people, abundant supply is the enemy of capital growth. So I'm not looking for growth corridors. I'm looking for areas where capital growth increases. And if you're looking at the concept of gentrification over time to help increase the value in your area, that's unlikely to happen in new areas. In those new suburbs, in the areas where there's physical growth, lots of new houses, house and land packages or apartments, a lot of the young families are living, they're overcommitting themselves. They're committing themselves to the max to get into the housing market, and we all have to when we start. But they're the areas also where tenants in general are living week to week as well. So I'd rather be investing in areas where owner-occupiers are more affluent, as we said before. You mentioned Brisbane. I believe leading up to the Olympics, with infrastructure development, Brisbane is going to perform very well, but partly because of internal immigration. So while immigration from overseas is in particular going to Melbourne and Sydney, but a little bit to Brisbane and Perth, a lot of people, not just because of COVID, but it's continued on since, are moving up to Queensland. And that's actually now going to be on the, it's a new world city. Melbourne and Sydney are the established cities that are known around the world. But Brisbane, with the Olympics, is going to attract a lot of attention, a lot of tourism. Now, we know that the Olympics didn't make a huge difference to property prices in the short term in Sydney, nor did the Commonwealth Games in Melbourne or Brisbane. So I'm not suggesting invest there because of the games, but more because of the demographics. More affluent people are moving there, big jobs are there, higher wages are there. Perth has underperformed for well over a decade. Perth values have hardly moved at all. Yes, it's got to catch up a bit, but it's almost a different, I'm going to offend somebody, a different country. It's on the other side of the world. In fact, I think Perth wanted a seed from Australia a couple of years ago, Western Australia. And it's not a mining town. It's not a one-horse town, but it is very dependent upon a couple of industries. So I'd rather be investing for the long term in locations where there are multiple industries and higher paying industries. It's just going to add some stability. So again, avoid the off the plan, those growth areas, and stick to more established areas. I'd rather buy an established apartment, even though they haven't performed as well in the last decade or so. But moving forward, the new round of apartments that are going to be built are going to come on the market at a much higher price, only because they have to, and developers won't be building them until they achieve higher prices. That's going to pull up the value of established apartments, Candice.
Okay, so if, for example, someone listening had an apartment, right, they've held it for 5 to 10 years and they kind of feel like the growth is maxed out there, even though it's in an established area, say 15 kilometres from Sydney CBD, do you think there's potentially more upside now from all things considered?
Well, the growth is maxed out. In 10 years' time, it'll be worth more. Will it outperform a house? What's the highest and best use of your funds? That's the sort of thing that we like to do by putting a strategic plan together and using numbers and figures rather than emotion. So if you bought something, I think you've got to treat your property investments like a business. It's a bit different for your house because when you choose a house, you're buying for emotional reasons, where the kids go to school, the neighbourhood you want to live in. But for an investment, there's significant costs getting in and out. So you've got to make sure you can outperform the averages if you do get out. But interestingly, as you mature and as your investment matures, as your property portfolio matures, often the properties you first bought are not appropriate for you anymore. You're playing a different game there. So sometimes if you're playing the long-term game, yes, you take a short-term loss to actually, because you make a mistake. I mean, the first 10, 15 years, or 10 years, a lot of people are just learning what not to do. And they regret the investment decisions they've made. And one of the mistakes they make is holding on to an underperforming property. Don't expect a first-class return from a second-grade property.
Which is interesting, that stat you said earlier on. I think you said 50% of homeowners or investors sell within the first 3 to 5 years. So that's the reality of investors. That's the reality of, yes, I've done my numbers wrong and I'm impatient and I'm emotional and I wanted something else than I realized. So that's a pretty confronting statistic if we think about it that way.
That is not a new statistic. You would think that currently, with all the blogs and all the podcasts and all the experts, that there'd actually be less errors made. The answer is that hasn't changed over the years.
We're human. We make mistakes. You're right, we do. We're emotional. We get in our head too much.
We're human.
All right, well, thanks for clarifying that. Let's take a break. But before we do that, we'll just tease out what we're going to be talking about next. We're going to be asking you, Michael, your preferred property investment strategies. I'm going to ask you a question about renovations as well. Before we do that, let's first hear from our sponsors.
And we are back. All right. So, Michael, what are the potential risks and challenges that property investors may face in the Australian market, and how can they navigate them effectively?
Well, I think partly navigating them is having a good team around and not trying to do it on your own. But the property markets are fragmented. We said that right at the beginning. So there isn't one market and some will outperform others. And we had a little bit of a talk about why that could occur and how to avoid that. Also, listening to the wrong people and buying the wrong property is an issue. But also understanding the property market cycles. It always will. There's going to be years when property values increase, like this year. Periods when they go down, like last year, 2022, periods when they stagnate for a while as well. So it's important to understand that principle and not get despondent. But I think one of the big factors people don't understand when they get into property is that it's a game of finance with some houses thrown in the middle. So property investors have not just enough finance to buy them a property, but strategic investors get a financial buffer in place to see them through the ups and downs, through things like the rising interest rates that we've all experienced in the last 12, 15 months. So they get finance to buy them time to ride through those cycles. And I think the other factor is understanding that you really need a long-term focus with property investing, not trying to outperform the market this year or next year, not buying the next shiny toy, the next big hotspot area, because we found this year's hotspots tend to be next year's hotspots. Buy in areas that have always outperformed. Property investment is simple if you follow those rules, but it's too simple for some intelligent people who try and make more out of it than it is.
Yeah, no, that definitely makes sense. And I guess bringing it back to our audience and what Candice and I do on a day-to-day basis, we say this all the time. It's really time in the market. It's patience. It's having that cash buffer when equity markets do go down. In our end, we actually like to top up good companies when they're being sold. And luckily with properties, they're not valued every day or they don't move around.
Yeah.
Every second, so people don't panic as much because it's a bit more illiquid to sell. Whilst in our world, people panic and sell their equities, which is generally the worst thing to do.
Now, interestingly, if anyone tells you shares only or property only, run away very quickly. So I believe a balanced portfolio is important. Maybe I could suggest my long-term preferred strategy because it'll bring together a couple of the things we've said. You're different age to me. Our audience is all different ages. So we don't know what the market's going to be like in 10, 15, 20 years' time. We don't know if you're going to be able to negatively gear or not, whether you can access your super, what the pension age is going to be, what interest rates are going to be. So you've got to make a plan, but you've also got to allow things to be flexible. And I think the end game for all investors should be that you own your own home when you go into your golden years with no debt. Now, I'm not giving financial advice. I'll give you the disclaimer there, but you should own your own home with no debt.
Agree.
Then you should own a property portfolio and have the loan-to-value ratios lowered such that it's at least washing its face near the end of your property journey when you're not getting strong income from other areas. I also believe you need areas of cash flow, which could be shares, could be your superannuation fund, could be maybe commercial property, because residential real estate is not as cash flow intensive as, but you need a balance of assets at the end to get into your, and of course you're also going to have superannuation, and again we can't give advice on superannuation here, that's what your team is specialised in. I believe in having a balance like that and then working towards that over time.
Music to our ears, Michael.
Absolutely. And I think the thing is, for some clients that the situation was right for them, they've actually purchased and had commercial property in the self-managed super fund and had residential property in the self-managed super fund and have been lucky enough to sell those assets tax-free and make quite a large gain. So there's definitely things where both worlds collide as well.
Oh, yes. But you've got to know what stage of the game you're at. So asset growth first and then eventually cash flow. So people buy property because they're looking for more cash flow. I remember in the old days when I used to sit with clients, I've got a team of people who do that. Now they'd come and say, I want to buy a property so it'll pay for my kids' school fees. I want to buy a property so it can actually go on holidays. No, that's not how residential real estate works.
So we've talked a lot about, the rationale behind it, the methodology. Don't get emotional. Make sure it's a plan that's going to work for you and your lifestyle. That's clear as day for us. But can I walk us through the emotional aspect if I can? I want to hear your insights into renovations, because you hear the saying, don't overspend or overcapitalize on your house or apartment. What are your thoughts here? Do you believe potentially you should assess the situation and sell if the renovations is maybe going to cost too much and you can't see the upside potential? Or do you go, look, stuff it. This is my forever home and I love the neighborhood, like you said, in the community. So it doesn't really matter what I spend on the budget.
Okay, so if you're talking about homeowners, and I think that was the gist of your question, then at the moment, renovations are hard to do. It's hard to get builders. They're expensive. But it's actually still, in general, cheaper than the cost of buying and selling. Now, if it's your home, there's no capital gains tax involved, but there still is agents' fees and stamp duty, there's and purchase costs and all the hassles of doing it. So if you're planning to live in the property for a long time, and the latest statistics suggest that we're actually living in houses on average of 13 years now. It used to be 11, and apartments 9 years. It used to be 7, according to the latest figures from Domain. We're not moving as much as we used to, partly because of the costs, partly because in this current market, sellers are nervous. Hey, can I even find somewhere else? Do I buy first? Do I sell first? So I think doing a renovation makes sense. And just like when you buy your home, emotions are part of it. So if you buy an investment, yes, you shouldn't necessarily buy one just because you could live there or want to live there or want a holiday in that area. But if it's your home, your heart's got to sing when you come home every night. Your eyes have got to light up when you come home every day. So on that basis, I'm not offended by paying a little bit more for a renovation today. It doesn't have to stack up completely if it suits your lifestyle. I mean, we should enjoy our lives while we can. We just see the terrible things that are happening overseas. You see the health issues and other things that are happening there. Appreciate what we've got. We live in the best country in the world, in my opinion, the best time in history. Yeah, you can spend some money on yourself.
It's the lucky country, as we always say, right? So with the areas of growth and I guess certain property types, residential, commercial, industrial, do you believe there's a greater potential if we just think of capital growth in these subsections?
Okay, so commercial property works in a very, very different cycle to residential property. It's more yield-based and finance is different. And there's some blogs out now, some buyer's agents now, people recommending people buy commercial properties, even if they haven't got the budget for it. In my opinion, that's wrong. You've got to understand what game you're playing. In fact, that was one of my biggest mistakes. I got involved in commercial property early in the piece in my 30s because that's what the big boys did. I bought, in fact, I still even remember the address, 21 and 23 Dandenong Street, Dandenong industrial area there. It's not what I needed, but I thought I was, being a big boy, I sold those and I've done other things. I own a lot of commercial, residential, industrial properties. I've got a diversified portfolio now, but I've had to build up to that. So if you're wanting to build your asset base and capital growth, my suggestion is start with residential property. It's actually difficult to diversify in property as opposed to shares, only just because of the dollar value. But I've fine-tuned my strategies over the last 5 decades, and I use a top-down approach, a strategic approach. So I believe that 80% of the performance of your property is going to be related to its location, one that outperforms the averages, and 20% will be related to the right property in that location. Let's look at which state is going to perform strongly in the right stage of its economic growth. And then within that state, we look at areas where there's going to be jobs growth, because jobs growth is going to lead to wages growth, which is going to lead to people coming into that area who are going to want to rent initially and then buy initially. So we look at the state and then the right suburbs, and then within the suburb, look, every suburb you'd know in your own suburb, there's areas where you'd invest or live in and areas where you wouldn't, and then down even to the right street. Now, you've got to know the areas. So I jokingly say, there are some streets in Sydney where on the north side you've got magnificent views of the Sydney Harbour Bridge and the water, and on the south side you've got magnificent views of the houses on the north side. They've got views of the Sydney Harbour and the bridge and the water. So you've got to know your patch. And then once you find the right location, I use a 6-stranded approach to owning the right properties. Ones that only appeal to owner-occupiers. Not that I want to sell the property, but owner-occupiers, others are going to buy similar properties, pushing up local prices. Last couple of years where we looked at areas which were more investor focused, and they didn't perform as well because investors sell up when things are bad, while owner occupiers would rather eat Maggi noodles than sell up their homes. And also those type of properties that are owner occupier properties, investment grade properties in my mind, they appeal to more affluent tenants who are going to be able to pay your increasing rent. As an investor, I think it's important to remember that your future income is going to be dependent upon your tenant's ability to keep paying you rent. So you don't want tenants who are a week or two away from broke. So I look for properties with owner-occupier appeal. I look for properties below intrinsic value. That's why we avoid new and off-the-plan properties which come at a premium price. I look for properties with a high land-to-asset ratio. That doesn't necessarily mean a big block of land, but one where the land component's a significant part of the asset value. And remember, apartments have an attributable land value underneath them. Buying the big towers, you've got 200 to 300th of the land, but buying one of those medium density, older 3-storey walk-up apartments, you've got a tenth of the block of land underneath you. That's worth something. I look for areas with a strong area of strong capital growth. Also, I like properties with a twist, something a bit special, something a bit unique, something scarce, so that at the moment anything lets. But during times of when there isn't a shortage of properties like now, to buy or to sell, if it's got a better balcony, a double garage, more space, a courtyard, something with a twist. But we talked about renovations a moment ago. I also like properties with the ability to manufacture capital growth. I do like the concept of renovations, refurbishment or redevelopment. So rather than waiting for the market to do the heavy lifting, during a period of lower capital growth, you can actually manufacture some capital growth by doing good renovations or development.
I really hope all of our listeners are putting down those points because they are just fantastic. Honestly, such great insights. So your six-step approach. So I guess on this, Michael, I mean, we've spoken about it before, but I mean, a lot of investors are really looking at, do we want to look at capital growth or do we want to look at yield as a property investor? I mean, obviously it's nice to find a nice combination of both, but does it just kind of come down to individual circumstances, what's kind of right for them? Because you don't want people getting in a yield trap with property either, like they do with some equities.
Well, in my opinion, you've got to start, as I've said a couple of minutes ago, by having a plan. So everyone's circumstances are different. Everyone's budget is different. Everyone's risk profile is different. But again, if you look at the results of those who've been successful and developed financial freedom from property, they have not invested for cash flow. They've kept their job, they've kept their business, they've actually built an asset base. So it's got to be done in the right order. So cash flow, and that gives you choices in life, is important in the long term. But in the short term, asset growth.
All right. So you need to create a good property strategy plan. It's not just picking up anything and everything.
And a finance plan to see you through, yeah.
Absolutely. Those are such great points. Now, if you do this on the flip side, are there any, I guess, regulatory or legislative changes on the horizon that you know of that could negatively impact or positively impact property investors? And I guess, how should they prepare for these changes?
Well, I mentioned a while ago, prepare for your plans not to go to plan, but you should own the best assets you can in the correct ownership structures, and therefore you've got to get advice for that. Now, for some people, it'll be in their own name. For some people, it'll be in joint names. For others, it'll be in trusts or sometimes even in superannuation funds, even though that needs special advice, and some people are maybe making wrong recommendations there. So be careful whose advice you get from that. But own the best assets you can to weather the storm, because there will always be changes. The government is treating property investors as an ATM at the moment. There's been changes happening recently in Victoria. Well, they're calling it an Airbnb tax, but a short stay tax with different land tax changes. There were legislative changes, residential tenancy changes that made it difficult. I guess it's a cost of doing business. That's why it's good to get a good team around you and not be deterred by this. The other big change is actually finance, what the banks are able to lend you, and is APRA going to loosen the screws a bit? They've tightened it that there's a 3% lending buffer. If APRA makes some changes, as they will in due course when they realise interest rates have peaked, they may make lending looser. Keep an eye out for it, but don't be too deterred by all these things.
Look, politics will be politics. Regulations will change and regulators will always step in when needed. That's a no-brainer, right? But I guess what I wanted to go through with you now, Michael, if I can, is something that you just said, which resonated with me, was that, you know, the environment is always ever-changing. And one thing that is definitely an evident trend in the wrong direction, I would argue, is the gap between the top 10%, I would say, to the rest of us. The wealth gap is getting bigger.
It is, isn't it?
Yeah, and we're really seeing it in the property market. So I read a really interesting statistic that nearly 50 to 60% of the generation currently getting into the property market have had financial help in some capacity from the older generation.
Yes, the bank of mum and dad.
Yeah, so it comes back to your, I'm going to say team around you, but also support network around you in that sense. So are you seeing this trend getting worse over the years?
Unfortunately, it will. And that's a shame in Australia, where we don't want the wealth gap to widen. Having said that, those who have got wealthy parents are in for quite an inheritance tsunami in
Love
10,
it.
15 years' time as the baby boomers eventually are going to die. I hope my kids aren't listening to this. But bottom line, they're going to be left a lot as well. But currently, it's really hard for first home buyers to get in the market.
Mm-hmm.
But I bought my first property in the early 1970s, 72 or 73, I'm not exactly sure when. I went halves with my parents because I couldn't do it on my own. We paid $18,000. I put $2,000 deposit down. We put $1,000 each. 30-year loan for $16,000. Had no idea how we were going to repay it. Interestingly, we got $12 a week
Wow.
rent and we were excited. I ended up selling that property back to my parents, my half, because the inflation came, the property went up in value. I got married later. My mistake, I sold it. For my half share, it was worth $32,000 then. My wife, Pam, and I bought it back from my mother in the early 1990s for $260,000. I've since pulled it down, so I still own the first property, but there's 2 townhouses there worth maybe $3.6, $3.8 million from my $18,000 property. So that was started off with the help of Bank of Mum and Dad.
That's such a nice story. Well, I mean, that is a great success story because I guess that was pretty negative of us. It's a trend that's unfortunately going the wrong way, and we do need people of importance listening who can make change happen. We need it to be easier for first home buyers, right? To spread the wealth. So are there any other, short success stories or case studies that you've come across for investors or homeowners that have, achieved kind of what you just went through? A really great story.
Well, I mentioned a while ago that we had a recent audit of the results of our clients at Metropole, and we've been giving strategic property advice. So we're much more than buyer's agents. We don't just buy a property, but we start off first by putting a plan together and then helping people plan to become the people they plan to become and then implementing that. And we found that they were 7.3 times more likely to own 6 or more properties, be in that top 1% of investors. And when we looked at it, they had a number of things in common, but there were a number of things they didn't have in common. Their age wasn't. Some were young, some were old. Their background, their race, their income wasn't. So in other words, some had very high income. We see a lot of people with high income but poor financial discipline, and they don't ever build a substantial portfolio. And others with what some would call relatively modest incomes, but good financial discipline build substantial portfolios. So I think the common themes we found were they had a strategy, they got a good team around them, they recognised the importance of capital growth. We're repeating things that I've already mentioned to you before. They took a long-term view. They had the finance strategy, so they didn't have to sell up when interest rates went up. And they also knew that sometimes the right thing to do is nothing. People are so excited about it. I want to keep building. It's not the number of properties you own. It's actually the dollar value of them. And so I'd rather own one Westfield shopping centre than 50 secondary properties. So they understood the importance of that. And they also had risk mitigation strategies. They understood that risk is really what you hadn't thought of when you thought you understood all the risks. So they owned the right properties in the right entities, had financial buffers. They, in turn, eventually diversified, but in general, many of them owned properties in the same area. I mean, I know in shares and other areas you diversify, but if you found a good location, why would you go to a secondary location rather than buy another one? So I've got a very substantial property portfolio, and it's in probably 4 municipalities in my residential portfolio. I've got also commercial, industrial, and I've got things in other states. But in Melbourne, why would I go to a secondary suburb when I've actually found a good location? I think it was Warren Buffett who said something like diversification is for the ignorant.
That's actually a really good point. It makes a lot of sense. Now, I know, Michael, we've already kind of discussed the balance of short-term and long-term gains with long-term wealth-building strategies in property investment. But do you believe there's a specific timeline or a holding period that investors should really aim for to maximise their returns in the property market?
I think short-term is anything less than 10 years in property, medium-term is 15 years, and long-term, and that's what you should be doing, is 20 years plus. See, I said earlier on it takes 30 years to become financially independent through property, and that's because for a lot of people the first 5, sometimes 10 years is learning what not to do. As we've said before, they make mistakes, they end up selling up, they listening to different people and the wrong sort of people, and then you need a couple of cycles at least to give you strong growth, and properties double in value. Well, good properties 8 to 10 years on average, though it's more like 15 years that it takes the average property to double, but we want it to outperform the markets, and you need to build a substantial asset base, and as we said earlier on, at the same time, not just a property base. So you're going to need some of your spare cash flow to put into equities or other financial products. So it's a long-term game.
And it really comes down to, like you've said multiple times on this episode, putting the right plan and strategy in place and having the right people around you.
So it's been such a great, insightful conversation with you, Michael. Really taken a lot of value for me personally, and I think a lot of our listeners have as well. To end the chat, though, if we're building out a diversified property portfolio with residential, commercial, industrial, apartments, townhouses, houses, the whole gambit, plus, cash flow investments like shares, which we love, what resources, tools, education, hot tips, do you suggest for individuals to look for?
Well, as I said a while ago, diversification is the protection against ignorance. It makes little sense if you know what you're doing. So some people would actually say in property, as opposed to the share portfolio, if you found areas that outperform and first-class properties, I'd be owning more of those. I think eventually you should diversify from one state to another, because the Sydney market works at a different cycle to Brisbane, different cycle to Melbourne. So 2-3 years down the track, you go to the bank and say, hey, please refinance my Melbourne properties. Don't worry about the Sydney properties. And 2-3 years later, you say, hey, look, Sydney market's moved up. Let's refinance those to top up my buffers or get equity for another property. But be patient, take a long-term view, and interestingly, most of the things you read, most of the educational material you're going to get is not going to help you, because again, if you do what everyone else does, you're going to get the same results as them. So I think it really involves having a good team of advisors around you and continuously learning. One of the mistakes people make is, confirmation bias, and as financial planners you'd see this all the time as well. So I tend to listen to podcasts, read blogs from people whose opinions I don't agree with, just to keep testing my opinions, because one of the things that happens is if you keep doing well in property or any investment or in business, you tend to then exclude other areas. You're blind to other opportunities. Keep learning, but be careful who you're listening to.
Yeah, absolutely.
That's great advice. Thank you for that.
Really great advice and makes sense. So, Michael, if our listeners want to hear more from you, they can tune into your own podcast.
Yes, the Michael Yardney podcast. So before you finish, stop for a sec, pause, come back to this, but go on your podcast app and follow the Michael Yardney podcast. I also have a daily newsletter that last year was read by, I think, about 2.7 million people, propertyupdate.com.au. And there's lots of people's opinions there. All the experts, leading experts in property, write for Property Update. And Metropole, my company, is more than the buyer's agent. We help home buyers and investors create intergenerational wealth through strategic advice. Metropole.com.au.
Perfect. I was just about to ask that. Where can they reach out to you and your team if they want to engage your services? Well, thank you so much, Michael, for joining us today on Talk Money to Me. It's been such a great episode.
I had a lot of fun. I hope you enjoyed my chat with Candice and Felicity. Now, for regular listeners, I guess there was a lot of recap there, but maybe it just made you think of a couple of things you hadn't remembered or thought of for a while. And for the new listeners, well, thank you for coming along and spending the time. If you don't currently subscribe to this show and you listen to this, why not just pause for a sec and go to whichever podcast app you're listening to this on and follow the show or subscribe depending upon what your podcast app says, so that twice a week you get the regular sessions with my experts. Now, as another way of saying thank you for listening to the show, I've got a heap of bonuses for you. Just go to podcastbonus.com.au. I'll leave a link in the show notes for that as well, so that you can get a heap of ebooks and reports, my way of saying thank you to you. And in a moment, I'm going to be sharing my popular mindset message, but I hope that the discussion I had with Felicity and Candice gave you some comfort about the long-term prospects of the property market. Clearly, the media's full of mixed messages at the moment. There are negatives, there are headwinds ahead, but there's also positives for those interested in property investment. In particular, there's the strong population growth at a time when we're just not building enough properties, and the fact that all new properties being built that are going to have to be delivered, we're going to have to build more, they're going to cost more, and developers are not going to start building them until they can make money. They're not going to take a risk. All that means is the next round of properties are going to cost more, pulling up the value of the right sort of established property at the moment as well. So if you're not sure, should you get into it? Is it too early? Or are you worried about buying in the wrong spot? Or maybe the banks have throttled you, restricted you a little bit. Maybe you're wondering, should you buy a home first or invest first? Maybe you've got a duck property and you want to sell. Or maybe you just want an independent set of eyes to assess how your property portfolio is going. Why not have a chat with my team, turn to the proven, trusted team at Metropole, and take advantage of our experience to give you sound, unbiased advice in the current confusing property markets. We're much more than just another buyer's agent. We help our clients safely create intergenerational wealth through property. So go to metropole.com.au and organise a complimentary wealth discovery session. Whether you're just getting started or wanting to grow your portfolio, our team can help you using the time-tested frameworks that I've fine-tuned over 5 decades, and we've helped clients over the last, over 20 years be involved in more than $5 billion worth of property investments. Metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message to you today, I'd like to share with you 11 positive things about getting older that no one really tells you about. And now that I'm a bit older than most of the people listening to this podcast, and maybe over the years I've become a little bit wiser, I've realised that life's a journey of lessons. It's a journey of experiences. It contains successes, and boy does it contain mistakes along the way. And of course, there's lots of great things about getting older that no one tells you about, so I'd like to share 11 of those with you. Hey, maybe it'll give you something to look forward to. The first thing I'd like to share with you is I've learned you don't always have to be right. I remember when I was young, it was really important to be right. Well, as the years passed by, I began to understand it's often better to lose a few battles in order to win the war. So I've chosen which battles to fight and which not. Sometimes it's better to be happy than to be right. The second lesson I've learned is not to judge. You see, early on in life, we tend to want material things. We tend to strive for more things. But as we get older, we realise that stuff isn't as important as people and relationships. And we learn not to judge, but to accept people as they are. Another lesson as you get older is you begin to want less. We accumulate so much stuff on our journey through life, and much of it's redundant and in excess of what we actually need. So as we get older, we begin to realise that sometimes less is more. It's an incremental understanding that we don't need to surround ourselves with a whole lot of material things. Another lesson I've learned along the way is you gain more confidence in making decisions as you get older. It's true that age does bring wisdom, but it also does bring confidence. Now, why? I guess it's because as we get older, we accumulate experiences, and our life lessons are powerful tools to draw from when making future decisions. We've made the mistakes, but we've also learned from them, or I hope I have, and this instills an innate confidence for future decision making. As I go through these life lessons that no one teaches you about, some of the good things about getting older, it's one that your children become your friends. It's hard to think of our children as friends when they're first so dependent upon us, And then they become a bit more rebellious, and there's a period of time where they wonder about you, sometimes even hate you during the teenage years. What nobody tells you is that as they become adults, they grow their own lives and fulfill their own dreams. We as parents take on a different role. Children now return to the family home as individuals in their own right and as friends, and I'm very proud of the relationship I've got with my 4 children. I've also learned along the way that you understand there's no point in telling anyone what to do. At a certain age, you realise there's no point in telling others what to do. Actually, if you think about it, being given advice you didn't ask for never felt nice anyway. Yet I'm still seeing lots of people trolling me on YouTube, in particular, trying to tell me, push to me, their points of view. As you get older, you also learn that wrinkles should be worn with pride. Later in life, we realise that we're fortunate to be growing older and that wrinkles stand for a testimony to our experiences. It shows that we've successfully navigated the troughs and the peaks of life. So wrinkles represent the days of our life, each telling a different story. A couple more things I'd like to share with you that I've learned that are good about getting older. And one is we're able to treat our parents with unconditional respect. Now, unfortunately, I've now lost both my parents. They've passed away. But as you get older, our parents, although we love them, may have driven us mad at some points in our lives. And for those of us with children ourselves, isn't it interesting? The pattern's repeated. And as we get older, we learn to treat our mothers and fathers with respect and how to have patience as they reach the autumn years, because we've got a better understanding of the trials and tribulations that they've gone through in their own process of ageing. Another lesson I've learned, a good thing about getting older, is it's okay to play the fool again. You know, as children we laughed, we played the fool and generally didn't think too much about what other people thought of us. Then our egos developed, self-awareness set in, and we began to rein in our inner child and squash that idiosyncratic part of us that was once so spontaneous. Then when we reach a certain age, it begins to matter a lot less what other people think, and not taking ourselves so seriously becomes an option once again. There's 2 more good things I'd like to share with you that I've learned about getting older, and one is you learn not to criticise. As we get older, we learn there's little value being gained in criticising anyone else. If we need to say something, it's far better to say something positive than to dwell upon the negative. And the last good thing I'd like to share with you today about getting older is that you're thankful for growing old, because not everyone grows old. Many die before their time or in their primes of their life, and I've seen a number of my friends and professional colleagues who are no longer with us anymore. So with age comes gratitude and the knowledge that with every passing year we're privileged, and being grateful becomes a daily ritual that enhances our lives in so many positive ways. So I hope that my reminiscing has given you some hope for your future as you get older, because things do get better. No matter what's happening with your life at the moment, take a positive outlook, take control of your circumstances, and remember, the best is yet to come. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?